Couche Tard has just announced its intentions to buy the largest convenience store brand in the entire world. However, this transaction has been recently put on a pause by the 7-Eleven CEO. So today we'll figure out what is the impact of this type of news on the valuation of this company, and we'll make a full stock analysis on the company Couche Tard with the ticker ATD. As always, we'll first start by checking out what is their business model, so how are they able to generate their income, and then we'll make a quick fundamental analysis followed by price prediction with different valuation methods to find what is the true intrinsic value of this company. Founded in 1980 by Alain Bouchard, Couche Tard was initially a small convenience store opened in Laval in Quebec. But over the last couple of decades, we've seen that Couche Tard has been expanding pretty fast to open over 16,000 stores in a bunch of different countries such as Canada, the US, Mexico, China, Japan, and Ireland. This incredible growth that they've been able to achieve has been linked to multiple acquisitions that they've been able to complete over the last couple of years. One of their most influential acquisitions that they've made over the last couple of years happened 20 years ago, where they've acquired for about $830 million the company Circle K. Nowadays, worldwide, we can find Couche Tard under three main banners, which are Couche Tard, Ingo, and Circle K. This has made that over the past 5 years, Couche Tard has gained some tremendously great value, where it is now worth over $50 billion. And this also makes that the company is currently the second largest convenience store brand in the entire world by number of stores, just behind 7-Eleven. But now let's see how this company in 2023 has been able to generate close to $100 billion. As any great convenience store brand, Couche Tard is generating the largest part of the revenue from the sales of the fuel of cars that they are selling to their different customers, but it also comes from the sales of the different products that we can find in their stores, for example, foods, tobacco, and alcohol. Plus, with the reality of tomorrow's environment, Couche Tard has already started to adapt its business model, notably to offer great electric vehicle chargers to their different customers. However, at the moment, these chargers are still mainly located in Europe and in their North American retail stores. And so, just like big oil companies that are starting to implement even more renewable energy sources to their business model, this transition has also been implemented to Couche Tard business model since a few years ago. But now the real question is to know whether or not the most recent proposition of Couche Tard to acquire 7-Eleven will help the company to grow even more in the future. Initially, the offer made by Couche Tard to acquire 7-Eleven was made to about $38.5 billion, or an average price per share of about $15.26 per share. If this type of offer would have been accepted, it would have given some great valuable assets to Couche Tard in the form of over 87,000 stores of 7-Eleven worldwide. This would have also given them great supermarkets, food producers, household goods, retailers, and financial services companies that are held by the parent company. And with such a partnership, this would create a real mastodont in the convenience store field. However, over the past couple of days and weeks, we've seen that the 7-Eleven CEO has been declining this offer, saying that this wasn't in the best interest of its shareholders and that it could face antitrust challenges in the US, where the combined company would be the biggest convenience store operator by considerable margin. And so 7-Eleven board of managers have clearly said that they had no intention to lose their full autonomy on their company. It is why even if both 7-Eleven and Couche Tard are still stating that they are both open to more discussion, I personally believe that if Couche Tard isn't willing to overpay for this deal, it is most likely to fall off. This isn't a bad news itself when we know what are the massive cons that could occur with different merging and acquisition. While we know that this type of acquisition has the objective to eliminate or reduce the overall competition by also giving some more potential of growth for their company, there are still plenty of problems that could occur from it. The main one that comes in mind is the potential danger of overbidding on the acquisition of a certain company, which could have the impact to dilute the current stake of the current shareholders. And we can clearly see that the owners of 7&I has no will to let go of their ownership of the company for nothing. especially when we know that the first offer made by Couche Tard was slightly below its current valuation at the moment. But even if Couche Tard has stated that they were disappointed of the refusal of its friendly takeover offer by the Japanese owner of 7-Eleven and that they remain focused on reaching a deal, the company itself is still a very solid business. By looking at their more recent earnings report, we can notably see that their EBITDA have been growing year over year by about 5%, driven by a gigantic increase in their road transportation fuel revenue in their European market by over 110%. This massive increase can notably be explained by the massive acquisition that Couche Tard has made at the beginning of the year, where they've acquired over 2,000 service stations from Total Energies in Europe for an estimated 3.1 billion euros. While this type of news and this type of growth represent some great news for the investors, this has also had the impact to increase the total debt of the company and at the same time the total interest that they are paying, which has also had the impact to reduce their total free cash flow. Nevertheless, over the past couple of years, we've seen that Couche Tard has proven its ability to integrate other businesses to its current business model. So it is definitely very interesting to see how the 7-Eleven deal will finish. But now let's examine together what is the true intrinsic value of Couche Tard. First, we can see that Couche Tard is currently worth over $70 billion with a pretty good price to earnings ratio, slightly below 20, as well as great price to sales and price to book ratio, which are all indicating that this stock would currently be undervalued. In terms of the profitability of the business, we can see that they've been achieving some pretty average profit and operating margin over the last 12 months, but they've still been able to achieve some great return on equity during the same period of close to 20%. During that same cycle, we can see that the company has generated some revenue of over $71 billion, and over the last quarter, we can see that their revenue have been growing by 17% and their earnings growth, however, have been diminishing by about 5%. As I mentioned earlier, since Couche Tard is acquiring a bunch of different companies year after year, it makes that they have quite a lot more debt compared to their total cash position, and it is also well reflected in their total debt to equity ratio that is over 100%. In terms of the volatility of the stock represented by the beta on a 5 years period, we can see that Couche Tard tends to fluctuate pretty much as the overall market with a beta of close to 1. Nevertheless, over the last 52 weeks, we can see that the market has been up by over 8% compared to over 31% for Couche Tard. Add to this, we can see that Couche Tard is giving a dividend slightly lower 1% that is, however, financed with a super low payout ratio of only about 17% right now. This is simply showing that Couche Tard at the moment is mainly using their net earnings to reinvest it right into the company to make new acquisitions instead of giving bigger dividends to their shareholders. In terms of the total revenue progression over the past 3 years, we can see that from 2021 to 2023, the revenue have been growing, where in 2024, they have slightly started to drop. Add to this, during the 2024 years, we've seen that certain of their expenses have started to increase, such as their interest expenses on their loans. So it has been reflected pretty much in their total net income progression over the past 4 years. In terms of the operating cash flow, despite a certain drop in 2022, we can see a great overall progression over the past 3 years, which has been linked to an incredible progression of their free cash flow over the past 12 months compared to what they were 3 years ago. But now, to determine what is the true intrinsic value of this company, we'll be using different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so with these hypotheses, we can find that the results would be showing that this stock would currently be quite overvalued. This is mainly due to the fact that the company at the moment prioritizes growth compared to their dividend yield, which obviously impact the total results. Then for the second model, which is the dividend discounted model, we can see that with the average growth rate that is bigger than the weighted average cost of capital, it unfortunately makes that this model won't work. For the third model on our list, analyst will be using the discounted cash flow model, where we will simply discounted all the future free cash flow of the company to find what is its project value. So the first thing we need to find is our weighted average cost of capital, which is simply by calculating what is the cost of debt, the cost of equity, and the cost of debt and equity, which is giving us our WACC. And so with these hypotheses, we are able to find the future free cash flow of this company, which is giving us an intrinsic value of about $136 per share. And with the current value of about $76 per share, it makes that this company would currently be undervalued. Finally, for our two last models, we'll be using the Graham's original value formula and the Graham's revised value formula. And so with the original value formula, we find that the company would currently be undervalued, and with the revised value formula, it is giving us an overvalued stock. As you've been able to see in this video, Couche Tard is a very interesting company that is mainly focused on growth and making new acquisitions, as we can see where there are now intention to buy the 7&I company. When you combine this with excellent financial health and great financial results over the last couple of quarters, this could represent a great combo for potential long-term capital appreciation. Nevertheless, on your side, if you're looking to find another excellent Canadian stock that has been growing extremely well over the last couple of months, well, check out the video that's gonna be right over here, and I will see you soon. Peace!